In October 1907, America had no central bank, no safety net, no emergency switch, nothing. Standing between the country and total collapse. So when the whole financial system started falling apart in a matter of days, the United States government couldn't save it. One man had to, with his own money and his own word. Here's something that sounds impossible today. For most of American history, there was no Federal Reserve, no central authority controlling the money supply, no lender of last resort. For 77 years, the U.S. banking system ran on something close to improvisation. Thousands of independent banks, no coordination, no safety net. If a bank ran out of cash, that was the bank's problem, and often it became everyone's problem within days. You have to understand how fragile this made everything. Banks in 1907 didn't keep piles of cash sitting in vaults for a rainy day. They loaned most of it out, kept a small reserve, and trusted that not everyone would want their money back at the same time. That trust was the entire system. Not gold, not government backing, trust. And this wasn't the first time that trust had cracked. America had already lived through panics in 1873, 1884, and 1893, each one triggered by something different, but each one following the exact same pattern. A shock somewhere in the system, a wave of fear, a run on cash, and a government standing on the sidelines with no real way to intervene. After the Panic of 1893, one of the worst depressions in American history up to that point, even the federal government itself nearly ran out of gold reserves. It took a private loan, arranged personally by, of all people, J.P. Morgan, to keep the U.S. Treasury solvent. Let that sit for a second. 14 years before the events of this story, Morgan had already bailed out the government once. By 1907, he wasn't just a wealthy banker, he was unofficially the emergency backstop. The country didn't officially have. Congress kept treating each crisis like a one-off disaster instead of a symptom of something structurally broken. And in the autumn of 1907, that unfixed flaw was about to be tested harder than ever before. And that's when the trust really broke. It started, of all places, with a failed attempt to corner the copper market. Two brothers, F. Augustus Heinze and Otto Heinze, believed they could manipulate the stock of a company called United Copper. Their plan was simple. On paper, buy up enough shares that short sellers, people betting the stock would fall, would be forced to buy back shares at inflated prices to cover their positions. It's called a corner, and it works, until it doesn't. The Heinze brothers miscalculated badly. Instead of a short squeeze, the stock collapsed. United Copper shares that had been trading near $60 a share crashed to almost nothing within days. Normally, this would be a footnote, a bad trade. Some rich men lose money, life goes on. But here's where things took a dark turn. F. Augustus Heinze wasn't just a copper speculator. He was the president of the Mercantile National Bank, and he had deep connections to a web of trust companies, financial institutions that operated like banks but with far less regulation and far smaller cash reserves. This is the part most people miss. Trust companies were the shadow banks of 1907. They took deposits, they made loans, they looked and acted like banks in every way that mattered to ordinary depositors, but they weren't required to hold anywhere near the same cash reserves as regular banks. They'd grown explosively in the years before 1907 by offering higher interest rates and looser lending standards. It was a good deal, until people started asking for their money back all at once. When word spread that Heinze was connected to the failed copper corner, depositors panicked. Not about copper, about their own money. If the man running these banks was involved in a wild speculative scheme that just blew up, what else was going on? Behind the curtain, rumors started spreading about which banks and trust companies were connected to Heinze. And in a system built entirely on trust, rumors are just as dangerous as facts. The rumors landed hardest on one institution, the Knickerbocker Trust Company. It was the third largest trust in New York. Respected, established, run by a man named Charles T. Barney. Barney had some financial ties to Heinze's circle, enough for the whispers to attach to his name. And, once they did, something happened that had never happened at this scale before. A bank run in the modern sense, playing out in real time, driven almost entirely by fear rather than fact. On October 22, 1907, a line began forming outside the Knickerbocker's doors. It wasn't a line of people making withdrawals for rent or groceries. It was a line of people trying to get every single dollar out before the doors closed for good. Within 3 hours, the Knickerbocker Trust Company paid out over $8 million. Adjusted for today, that's well over $250 million. Gone in a single morning. By early afternoon, the Knickerbocker suspended payments. It simply ran out of cash. And that's when the real crisis began. Because once the the third largest trust company in New York, failed to pay its own depositors. Nobody in the city felt safe anymore. Most people think a bank run is just about one bank, but the reality was much worse. Panic doesn't stay contained. It spreads to the next institution, and the next, and the next, because depositors don't wait around to find out which bank is actually in trouble. They just want their money out of any bank that might be connected. Within days, the panic hit the Trust Company of America, the second largest trust in the city. Then smaller banks. Then the stock exchange itself started to seize up, because brokers couldn't get short-term loans, called call loans, to finance their trades. Without that daily flow of credit, the New York Stock Exchange was on the verge of shutting down entirely. Stock prices collapsed. Businesses couldn't get loans to make payroll. Banks in other cities, worried about New York's contagion, started hoarding their own cash and refusing to send money to New York banks, which only made the shortage worse. This is the terrifying part. There was no government agency, no central bank, no FDIC insurance, nothing. Standing between a rumor about one man's bad copper trade and the entire American financial system grinding to a halt. And the man who ran the U.S. Treasury at the time had almost no tools to stop it. It's easy to talk about this in numbers, millions of dollars, percentage drops, bank names. But pause for a second and think about what this actually meant for a normal person living in New York City in October 1907. If your life savings were sitting in the wrong trust company, you didn't find out from a headline. You found out when you showed up to make a normal withdrawal, and the teller told you there wasn't any cash. Maybe you'd spent 15 years building up that balance. Maybe it was meant for your daughter's wedding, or your retirement, or simply next month's rent. Newspapers from that week describe men and women standing in the cold for hours, some fainting, some being trampled as crowds surged toward doors that had already been locked from the inside. Small business owners who couldn't access their accounts had to lay off workers within days because they had no way to make payroll. Factories slowed production. Construction projects stopped mid-build because contractors couldn't get short-term credit to buy materials. This is the part Wall Street history often skips past. The panic wasn't just a story about bankers in a library. It was happening, in parallel, to ordinary working people who had absolutely no say in any of it and no idea whether their money still existed. That's the pressure Morgan was actually operating under. Not just save the banks. Save the banks. Before this spirals into something closer to a full depression, with millions of ordinary lives caught in the middle. With the government essentially powerless to intervene directly, the country's financial fate fell into the hands of a 70-year-old man with a famously terrifying stare and a nose so red and swollen from a skin condition that photographers were instructed never to use flash near him. John Pierpont Morgan. By 1907, Morgan wasn't just a banker. He was, functionally, the most powerful private citizen in American finance. He had already reorganized failing railroads, helped create U.S. Steel, the first billion-dollar company in history, and bailed out the U.S. Treasury itself once before, back in 1895, during a gold crisis. To understand why bankers and business owners across New York were willing to do almost anything, he asked, you have to understand the reputation he'd built over 4 decades. Morgan had a habit of walking into failing companies, firing the leadership, restructuring the debt, and turning chaos into order, a process so common it earned its own nickname on Wall Street. Morganization. He didn't just invest in companies, he rebuilt them from the inside, often against the will of the very executives who'd run them, into the ground. People feared him, people respected him, and in October 1907, both of those things mattered more than any government title ever could have. Morgan was 70 years old and had been planning to attend a church conference in Virginia that week, the Episcopal Church's General Convention, an event he cared about deeply and rarely missed. Instead, the moment word reached him that the Knickerbocker had collapsed, he boarded a train back to New York. He set up something close to a war room, not in a bank, not in a government building, but in the private library attached to his mansion on Madison Avenue. That room became, for about 2 weeks, the unofficial central bank of the United States of America. Morgan's first move wasn't to hand out cash. It was smarter than that. He gathered the presidents of New York's major banks and trust companies and had them bring their financial records, their actual books, to his library. He wanted to know something crucial: which institutions were merely facing a panic, a temporary liquidity problem caused by fear, and which ones were actually fundamentally insolvent, doomed no matter what anyone did. This distinction mattered enormously. If Morgan poured money into a bank that was already bankrupt, on paper, he'd be throwing good money into a hole. But if he could identify the institutions that were fundamentally sound and just needed a bridge to get through the panic, he could save them, and in saving them, calm the entire market. Teams of accountants worked through the night, auditing bank after bank by candlelight and gas lamp, reporting back to Morgan before dawn. Most people think Morgan just showed up and threw money at the problem. But the reality was much more calculated. He was running a triage unit for the entire American economy, deciding in real time which patients could be saved. The atmosphere inside that library was nothing like a boardroom. Witnesses described Morgan pacing for hours, playing solitaire late at night to think, occasionally exploding at bankers he felt weren't contributing enough to the rescue effort. At one especially tense moment, Morgan grew so frustrated with the trust company presidents, men who were reluctant to commit their own institution's money to save their competitors, that he reportedly locked the library doors and made it clear nobody was leaving until an agreement was reached, somewhere around 4:45 in the morning. With Morgan literally standing near the exit, the trust company presidents finally signed a commitment to contribute emergency funds. It sounds almost unbelievable today. A private citizen, in his own home, physically pressuring the heads of some of the largest financial institutions in the country into an agreement that would determine the fate of the national economy. But that's exactly what happened. There was no regulator in the room, no president, no law being enforced, just Morgan's will, and the fact that everyone in that room understood what would happen to all of them if the system collapsed completely. The next major test came almost immediately. The Trust Company of America, the second largest trust company in New York, was hemorrhaging deposits, just like the Knickerbocker had. Morgan's auditors worked through the trust company's books overnight and determined something critical. Unlike the Knickerbocker, this institution was solvent. It had enough underlying assets. It just didn't have enough cash on hand to survive a run driven by panic rather than facts. So Morgan made a decision that in hindsight changed the entire trajectory of the crisis. He decided to save it, publicly, visibly. He organized the other major bank presidents into what became known as a money pool, essentially. A coalition where the strongest banks pledged emergency funds to prop up the weaker but solvent institutions, and to make sure everyone knew help was coming. Word was deliberately leaked that Morgan himself was personally backing the Trust Company of America. The next morning, when the line of depositors formed outside the Trust Company of America, Morgan made sure the money was physically visible, stacks of currency brought in and counted out in plain view, so that anyone in line could see the institution had the cash to pay them if they wanted it. And here's the strange, almost counterintuitive truth about bank runs. The moment people believe the money is actually there, most of them stop wanting to take it out. The run slowed, then it stopped. Morgan had just demonstrated, in real time, the single, most important lesson of the entire crisis. One that would eventually reshape the American economy, forever. A financial panic isn't really about money running out. It's about people believing it might. Just as it looked like the trust company crisis was stabilizing, a new front opened up, and this one threatened to be even worse. On October 24th, the president of the New York Stock Exchange, Ransom Thomas, came to Morgan's office in person with devastating news. Brokers across the sea exchange had run out of the short-term call money they needed to finance ongoing trades. Without an emergency infusion of cash within the hour, Thomas warned, he would have to shut the exchange down early, something that would send an unmistakable signal of total panic to the entire world. Morgan reportedly gave Thomas 16 minutes to get back to the floor and tell the brokers that money was coming. In that time, Morgan summoned the presidents of New York's leading banks to his library and essentially strong-armed them into pledging $25 million, in today's terms, well over $700 million, to keep the exchange's credit lines open. The money arrived, the exchange stayed open, and for the second time in 3 days, one man's personal authority, not any government agency, had stopped the American financial system from collapsing in real time. But he wasn't done, because a few days later, the crisis found its way to something even bigger, the entire city government of New York. By the end of October, panic had drained so much cash out of circulation that even the city of New York couldn't secure short-term loans to keep operating. The city was, functionally, at risk of default. Morgan personally arranged emergency financing to keep the city solvent, once again pulling together capital from the same coalition of banks he'd been leaning on for over a week straight. By this point, Morgan had been working around the clock for days, sleeping in short bursts, chain-smoking cigars, coordinating a rescue effort that touched trust companies, the stock exchange, and now an entire city government, all from a private library using no government authority whatsoever. Just reputation, relationships, and the sheer terrifying force of his will. There was one last crisis, and it was arguably the most dramatic of all. A major brokerage firm, Moore & Schley, was on the verge of collapse. It had borrowed enormous sums, using stock in the Tennessee Coal, Iron and Railroad Company, TC&I, as collateral. If TC&I stock crashed, Moore and Schley would go down with it, and its failure could have triggered yet another wave of panic. Just as the crisis seemed to be calming, Morgan's solution was audacious. He arranged for his own company, U.S. Steel, to acquire TC&I outright, instantly stabilizing the stock and rescuing Moore and Schley in the process. But there was a catch. U.S. Steel already controlled roughly 60% of American steel production. Buying TC&I would push that dominance even further, raising up exactly this kind of corporate consolidation. To ask for an extraordinary exception, they needed his answer before the stock market opened the next morning. Roosevelt agreed not to pursue antitrust action against the deal, on the understanding that it was necessary to prevent a far greater national catastrophe. The deal closed. Moore and Schley was saved, and with that, the worst of the panic of 1907 was finally, officially over. Here's the part that should genuinely unsettle you. The system had just been saved, but by the personal decisions of one 70-year-old private banker, operating out of his home library, answerable to no one but his own judgment. What happens next time, if he says no? What happens if the man with that kind of power isn't as competent, or as willing to sacrifice his own sleep and reputation? What happens if there simply isn't a J.P. Morgan available the next time panic strikes? That question terrified politicians and economists alike. The United States had just watched its entire financial system survive by depending on the goodwill and personal fortune of one man. That is not a system, that's a gamble. And that fear, more than any single piece of legislation, is what finally broke decades of political resistance to creating a real, permanent lender of last resort in America. Here's the twist most people don't expect. You'd think the man who single-handedly stopped a national collapse would have walked away a hero. For a while he did. Newspapers praised him, politicians publicly thanked him, but the more people thought about what had actually happened that October, the more uneasy it made them. One man, unelected, unaccountable to voters, answering to no regulator, had just decided which banks lived and which ones died. He had personally decided the financial fate of an entire city, and by extension, the country. That unease eventually turned into a formal investigation. In 1912, the House of Representatives convened what became known as the Pujo Committee, led by Congressman Arnold Pujo, to investigate something Americans had started calling the money trust. The idea that a small handful of Wall Street bankers, with Morgan at the center, held dangerously concentrated control over American credit and industry. Morgan himself was called to testify. He was in his mid-70s by then. Visibly, one exchange, in particular, became famous. When he was asked whether banking was based primarily on money or property as collateral, Morgan insisted that the most important factor in whether he'd lend to someone was simply whether he trusted their character. It's a strange kind of irony. The very qualities that let Morgan single-handedly stop the panic of 1907, his personal relationships, his reputation, his ability to command instant trust from the most powerful people in finance, were the exact same qualities that now made Congress deeply uncomfortable. If one man's judgment, character, and personal fortune could hold up the entire American economy, that wasn't stability. That was a single point of failure with a heartbeat. Morgan died in Rome in the spring of 1913, less than a year after his testimony, and just months before the institution, partly inspired by his own actions, would finally become law. In the immediate aftermath, Congress passed the Aldrich-Vreeland Act in 1908, a stopgap measure, allowing banks to issue emergency currency during future crises. But everyone involved knew it was a patch, not a solution. Senator Nelson Aldrich was tasked with designing something more permanent. What followed was almost as secretive as anything in the crisis itself. In November 1910, a small group of the most powerful bankers and economists in the country boarded a private rail car under false pretenses, using only first names to avoid being recognized by railway staff and reporters, and traveled to a secluded members-only retreat on Jekyll Island, off the coast of Georgia. For over a week, in near total secrecy, they drafted the blueprint for what would eventually become the Federal Reserve System, deliberately structured as a network of regional banks rather than one single centralized institution, to make the idea of a central bank more politically palatable to a country that had rejected the concept twice before in its history. It took 3 more years of political fighting, public suspicion, and careful compromise. But in December 1913, President Woodrow Wilson signed the Federal Reserve Act into law. For the first time in the country's history, America had a permanent, government-backed lender of last resort, an institution designed to do, systematically and reliably, exactly what one exhausted, chain-smoking private banker had done from his personal library in October of 1907, decide, in a moment of panic, who deserved to be saved, and make sure the cash was actually there when people came looking for it. Here's what should stick with you. The Federal Reserve wasn't created out of careful forward-thinking planning. It was created because the country got a terrifying preview of what happens without one, and realized it had been relying on luck. Specifically, the luck of having one enormously wealthy, unusually decisive private citizen willing to spend 2 weeks of his life and a fortune of his own, money holding the entire system together by force of will. That's the uncomfortable truth buried at the center of this story. Every system you trust today, deposit, insurance, the Federal Reserve's emergency lending, powers, the entire modern architecture protecting your bank account, exists because, in 1907, none of it did. And the country came within days of finding out exactly how bad that could get. So here's the question worth sitting with. The Fed exists specifically to make sure no single event, and no single person, ever holds that much power over the American economy again. But every financial crisis since then, 1929, 2008, even 2020, has asked the same underlying question. 1907 did. Is the system actually strong enough on its own? Or are we still, in some quiet way, hoping someone shows up with a library full of ledgers and the nerve to use them? Think about 2008 for a second. Over 100 years after Morgan locked those bankers in his library, the US government found itself asking almost identical questions. Which institutions were fundamentally sound and just needed a bridge? Which ones were beyond saving? Who gets bailed out? And who gets left to fail? The names changed. The building changed. Committees replaced one man's judgment. But the core dilemma, deciding, under extreme pressure, who deserves to be rescued, never actually went away. It just got a permanent address. That's really what the Federal Reserve is, at its core. Not a magic fix. Not a guarantee that panics can never happen again. It's an attempt to turn one man's judgment, in one library, over 2 exhausting weeks, into a permanent, institutional process that doesn't depend on any single person being brave enough, rich enough, or awake enough to answer the phone. Whether that trade-off, giving that kind of power to a permanent institution instead of a private citizen, was the right call, is something economists still argue about today. But one thing's certain, the alternative, the one America actually lived through in October 1907, was far more fragile than most people ever realize. I make videos like this because history like this doesn't get taught the way it should, as a thriller, with real stakes and real people making impossible decisions in real time, with entire cities and life savings hanging on those decisions. If that's the kind of history you want more of, subscribe. You'll be joining people who don't just want the textbook version of events. They want to understand why the financial world actually works the way it does today, one hidden story at a time. And trust me, this is far from the strangest story money has ever produced.